Recording in progress. Time to go.
Woo! Let's do it.
Welcome back to another episode of the Brutally Honest Loan Officers Podcast. I'm Derek Brown. With me, as usual, Stephen Brock. So,
God,
buddy.
you sound so disappointed in that. Usual.
Not disappointed. No. That's okay.
Oh,
How's
the
your week?
love, the love. Past Valentine's Day, where love is in the air.
Yeah.
Oh,
Did
so
you have
how
a
was your
nice
weekend, buddy?
Valentine's Day?
What did we do Valentine's Day? Um, we went to the beer in no bourbon and bacon festival. So yeah, that was kind of fun
Okay. With the kids?
with the kids.
Did they try bourbons and beers and bacon?
They tried the bacon. They asked to try the bourbon. But I got a flight. I was like, oh, let's get the flight of thing, which is three. I would say probably three shots. I mean, it's three cups worth, and I think they're probably 1 ounce shots. But I was like, hey, Nikki, you want to try this with me? She's like, yeah, I'll try some with me. And in fact, she lied and barely tried any of it. So I
I mean,
was,
so are you supposed to take like a tiny little sip and like
you know,
nurture it? Like,
sipping and all that. I'm like, all right, well, like, I don't want to get a whole flight of them if you're not going to like try. Like, use my like, we go to this all the time, once a year in our community. My brother-in-law is there, so like, me and him will get a flight and we'll just kind of share it together. Like, that's enough. I don't need 3 shots of uh bourbon kind of thing. Well, she took like 2 sips and then I had the rest.
and then she drove home.
And then she drove home. Yeah, I was like, this is the greatest day ever. But
Oh
yeah, that's
man.
about it. What about
Nice.
you?
Well, my wife flew to West Virginia. Her family does a big Valentine's Day event. They own greenhouses there, so it's just like probably their number one event of the year. So she went there she likes to go and help the fam. So I had the kids solo. However, my wife did plan ahead, as she always does, and had the kids like Valentine's Day presents ready and stuff. So I just had to pull them out of the closet. So they woke up, did that. Then we went and got some breakfast and then hung out. We played in the woods when we got home. They wanted to make a big fire. So
Nice.
we went and found some sticks. Bennett's got like this little wagon kind of thing
Yeah.
and likes to fill it up with pine cones and sticks and then put it on the fire. So did a little bit of that. And I don't know. Then we had dinner at Nana's house. She cooked steak and lobster. My wife was jealous. Tony missed out.
Yeah.
Um, and then yesterday. I had to pick her up from the airport, and we have like our little calendar, family calendar. It's one of the skylight things.
Oh yeah, yeah, yeah.
And so on the calendar it says like Tony's flight from 4:50 to 5:50. And I didn't really pay attention to like the flight's longer than 1 hour, but I saw the 5:50. That's when she lands. Like basically it's 6. Like we got to be at the airport, parked and like close by at 6
Yeah.
because she's gonna have to get off and whatever. So luckily, I talked to her before her flight, and she was like, "No, Derek, I don't land at 6. I land closer to 5." And so I sent her a screenshot of the skylight calendar, and she's like, "I don't know why it says that." And I'm like, "Neither do I," but that changes everything
Yeah. Yeah. You've been
because,
sitting there for an hour.
well, no. So like we had gone to Epcot a couple weeks ago, just Tony and I, and then we had left Epcot and gone to Disney's Boardwalk where they have like different restaurants and stores and stuff like that. And within one of those stores, there was like a Disney long sleeve shirt and matching ears that she like really, really liked. And I'm like, okay, like that's a good Valentine's Day present. When she's gone, I'll take the kids to Epcot. And then we can sneak over here, get this, and we'll do it on Sunday because we can be here all day and then leave and go get mom. Except we're blacked out.
Oh.
We're blacked out this weekend because it's a holiday weekend. And so I'm like, okay. And then it's fine though, because we can, like, I can park at Disney's Boardwalk Inn, go and get the shirt, and then we'll just go pick her up. It'll add like 30 minutes to the drive to go get Tony.
Yeah.
But now I'm an hour short. Like, my whole plan just lost an hour. And I was in the middle of doing laundry. Bennett was napping. Like, so he had to wake up from nap a little bit early, and that's not always great. And then like we parked, we ran like kind of through the parking lot because we did not have time to wait.
Yeah.
So, but we got it. Picked her up from the airport, went to dinner, came home. Tony's back. My life is good. that was really my weekend.
All
But
for following your calendar.
I mean, listen,
You can only follow your
it's
calendar
almost
if it's
like Ron
right.
Burgundy. Like, if you put it on there, I'm going to read it and it's going to be true. You know what I
Yeah.
mean? Like, it's on our calendar. And
Imagine if you did, she would have called you and be like, "Where are you?" Like, you don't land
oh,
till 6. That's what it says.
yeah, oh man, that would have been so bad. So she would have Ubered at that point. Like,
Yeah, she'd be like, "Screw you."
well, no, because if I didn't know, then we would have been on the way to the boardwalk.
She could have.
So she would have been over here, and we would have been over here. Like, I just,
You would have
uh,
figured it out. Oh, that's great.
yeah. Okay, so enough about me and my wife and Disney and
Yeah.
bourbons.
What are we really talking about?
I've actually been going back and forth with a client right now on this very topic, conventional versus FHA. And technically, she qualifies for both,
Yep.
depending on the purchase price.
And I will say it's mostly sellers who think one is good and one is bad. So it kind of gets in their head. And there might be real estate agents that are like, "Oh, this one's good. FHA is bad and conventional is good." So that's usually people think you have bad credit with FHA, you don't have enough money, and conventional means good credit. And that's just not true.
Yeah. Like, here's the thing, it's not a one size fits all industry. There is not one loan that everybody typically qualifies for that's the best option for them. So, our goal as loan officers, loan originators, is to determine which loan best fits your short term, long term goals.
Yep.
And there are times where, for you specifically as a buyer, you may not qualify for one. Maybe you don't qualify for conventional, so you've got to do FHA. Doesn't
Yeah.
make it any worse or better. It's just what's available to you. So both can be great loans that help you purchase a home and start building generational wealth.
Because I want people that are listening to the it doesn't matter the loan type. It really depends on the loan officer. Did they do a good enough pre-approval up front? Did they collect enough documents? Do they actually know this person can actually close? That's what matters.
Dude, I can't tell you how many, like, I've won so many deals so far this year, like multiple deals this year. We're in February because another lender did a shit job.
Yeah.
Like, I had a veteran that was going under contract because Veterans United gave them a pre-approval, never talked about a contingency to sell their home or anything. He didn't have enough entitlement to purchase the new home with 0% down. He would have to pay off his mortgage or sell the house or bring $55,000 to closing. Now, here's the catch. He only owed 20. Pay your mortgage off. You restore your entitlement, you're good to go.
Yep.
That's less money out of pocket than bringing $55,000 down payment on the new house. And they had no idea, no clue.
It's just it's scary because like he would have found it last minute, but I have one right now that they came to me and they're like, "Oh, hey, we were already pre-approved for 400,000 with just my husband on it." And I was like, "Okay, that's a good starting point. Let's look at everything." They're like, "We're thinking about putting the wife back on it because she's on maternity leave, going back to a salary job. Like everything's going to kind of work out." So we're going over everything, and then he's not approved. Like I'm getting denied. Like I had got him down to like a 200 denied, and I'm like, what? Now, granted, you look at 400, you look at the back end numbers, and you're like, oh, the back end numbers, the cash to close, like yeah, he would be pre-approved, but they never ran AUS or which is the
Automated underwriting.
The DU or LP Fannie or Freddie on that. Like they never ran any of that. So he would have gone under contract, got a couple weeks in, and probably like a week or so in, and then got denied.
So what's the issue? Credit score or like?
Yeah, they don't have a. There's some lates and stuff like that on their credit, so there's not enough.
Yeah.
Now
So
if we
here's
had
the other
somebody
thing.
else
Like,
in there that's going to counterbalance it, so that's what we need.
yeah, if you have one borrower that's got like maybe less than favorable credit, and we can, income might be great, they have the money, and you could still get a refer, is what we call it, but you're not approved.
Mm-hmm.
Why? Because the automated underwriting system just doesn't love it. Yeah. Doesn't love the overall credit risk profile.
And I will say that FHA, Fannie, and Freddie have all gotten a little bit tighter, on their credit of what they will allow now. So it's definitely a difference there now.
Well, and there's times where it's also just history. Like My only credit card reporting is from 1 year ago, and I got a new car in September. And those are the two trade lines on my credit report. You might need to wait. Just
That
simply wait. You don't have a long enough standing history of borrowing money for an approval. I mean, that's just sometimes that's what comes up.
Yep.
So it really just depends. But we're going to kind of dive into the difference between conventional and FHA.
So what is a conventional loan?
I mean, conventional loan, it's not backed by the government. It's probably the most standard loan type people think of.
Yep.
It is most likely what your parents did when they put their 20% down to buy a house back in 1986. Um, it's and that's kind of just the gist of it. It is just your most common loan.
Yeah. And you have
And then
FHA, which is a government insured loan, which means the Federal Housing Administration, that's the FHA on it. Everybody always thinks that, oh, it's first time home buyer. And I'm like, so what's the A? They're like, assistance? I'm like, I don't know. I'm
no,
like, no.
no,
But that is a loan that the government is saying, hey, there's going to be a little bit less of credit could be on there. It could be less of a down payment, but they are ensuring to the mortgage company that is servicing and funding that loan that it is guaranteed that if something happens, that the insurance policy will kick in and make sure that the mortgage company gets their money back.
right.
That's what's on there. So it's a little bit less favorable than a conventional. It could be a lot less, but it could be just a little bit. That's what happens with it.
Well, and like we've seen this over the past few years. FHA can be a little bit more forgiving with credit,
Mm-hmm.
in debt to income ratios. Like, so you might get an approval for a conventional loan with a back end ratio of 45, meaning all your debts compared to your gross income is 45%.
Yeah.
FHA, you could go 50 or higher.
Yeah.
Now, I will say, let's not do that. If we're talking about household income, don't do it. Now, when I have got one borrower on the loan and like a husband or a wife or a partner is also working, but maybe has even worse credit or something like that, or, they've only been on the job so long. Sometimes I'll feel more comfortable if we've got somebody else in the house earning money
Yeah.
to push that DTI limit. Um, but otherwise, I mean,
And all
you're
the time
getting
when I
close
deal
to
with
50,
people,
you're talking about 50% of your gross income going towards your mortgage.
yeah, I'm with people all the time. Like, oh, they're like, we're at 56 back in. And I'm like, for you two to buy this house, I was like, insurance is going to go up, taxes are going to go up in a year or so.
Right.
So you're going to go from that 56 to 58, 59. So almost 2/3 of your income is going to the house.
Right. So like when it comes to conventional, let's go through like some of the advantages of it.
Yep.
And like, what would you say is the number one advantage to a conventional loan?
So FHA automatically has mortgage insurance on it no matter what.
Right.
Conventional
You could, by
depends
the way,
on,
when we say no matter what, like this is usually tiered to LTV, or your down payment.
yeah,
So if you were to put 50% down on an FHA loan, you're paying mortgage insurance
exactly. There is mortgage insurance on an FHA loan no matter what the down payment.
for the life of the loan.
Forever. It's not coming off. Oh, caveat, it will come if you put more than 10% down, it will come off in 10 years.
Yeah, but you have to request it too,
You
right?
got to request it, but in
Yeah.
10 years, that's when it comes off. Now, conventional mortgage insurance, if you have better credit, is usually cheaper. If you're putting anything under 20% down, you're going to have mortgage insurance on it. Now, you
Right.
can, some people pay it up front, they pay it every single month on their mortgage payment, but it can also fall off after you get to that. I think what's automatic, it's like 77 point something, it's like 78%
Yeah,
loan to value.
78%. So we always say like around 20% equity in your home.
Yep.
But you have to look at your amortization schedule. That's when it will fall off. And it is far back. It's not, it's like year
It'll
6.
automatically fall off.
That's when it's supposed to automatically come off. However, if
because it
prices
doesn't take into the fact that your house increases in value.
appreciates, right?
It just goes, hey, you will have the 20% equity at this moment.
So
And nothing changed.
yeah, if you haven't done any major renovations, if you're just going by, you've paid down your loan amount, your home price has gone up, and you've got that 20% equity mark, and it's been 2 years, you can reach out to the servicer and say, will you remove the mortgage insurance? They might, do a desktop appraisal type of thing. And if you've got the equity there, comes off.
Yeah.
So the other thing to consider too is like, I have this conversation a lot with buyers. Originally we're talking about putting 10% down. Their mortgage insurance is like $40. And so then they're like, well, what would it, if what would it look like if we put 20% down so we wouldn't have to pay mortgage insurance? I'm like, time out. So like let's just say 300,000, and I'm using examples or whatever. But this is usually how the conversation goes. $300,000 house, you're putting 30% or $30,000 out. That's 10%.
Yep.
Your mortgage insurance is $40.
$40. All right.
But in 2 years, you could probably have it removed. So 40 times 24, right? Do you know how much that is? $960. You're thinking about spending another 30 grand to save 960.
Yeah. If that's the reason you're doing it.
If your sole reason is because you don't want to pay mortgage insurance, stop. Take the mortgage insurance. Take that other 30 grand, invest it elsewhere. If you're comfortable with that payment, the mortgage payment based on 300,000, putting $30,000 down. So you've got a 270 loan amount. Bro, I would take that $40 mortgage insurance all day.
Yeah. You could take that 30 grand and put it in something and it's gonna pay for that mortgage insurance.
Yeah, 100%. Easy.
Yeah.
Easy. So, but it's also mortgage insurance is tiered kind of on conventional loans where the higher your credit score, the lower the DTI, or the higher the credit score and lower the DTI, the cheaper the mortgage insurance is going to be. Mm-hmm. Now, if you don't have great credit, you might be paying a lot for mortgage insurance. But conventional loans also, when Fannie Mae recently removed the credit score requirement, right? Exactly. Like they had a minimum of 600.
Yeah, no, 640. It used to be if you had under 640, you could not get a conventional loan through Fannie.
620. No, we went by 620.
Was it 620? Yeah, they completely removed it.
So now you technically could have a 579 credit score.
Yep. So same like FHA. FHA, there's really no. It's about 580 is when it starts.
Most investors, will purchase a 580 credit score FHA loan, but you're going to talk to some brokers that say, well, we can go as low as 500. You know what that interest rate and like what that's going to look like?
I mean, we have investors that'll go that low. You're just going to suddenly, if interest rates are in the high fives, low sixes, you're going to probably be sevens, eights.
Right.
Like that's the difference of it. So I love when people are like, oh, well, they could do it. Yeah. Okay, look at all the items on it. It's usually, hey, wait 3 to 6 months, have a credit plan, get that credit up, and then purchase.
Right. But I've also seen it where like we're looking at a conventional loan at first, not great credit, interest rates higher, and then that mortgage insurance is hundreds of dollars per month. Mm-hmm. Like, and I mean, I'm talking $600, $700, $800 per month, depending on the loan amount.
And that's a lot. FHA, it is so conventional, like you said, it moves. It depends on your credit, it depends on your down payment. That number changes. FHA, the mortgage insurance is the mortgage insurance. It's the 0.55, no matter what. That's exactly what it is. No matter if you have an 800 credit score with 50% down or a 580 with 3.5% down. Like it's the same mortgage insurance rate no matter what. Conventional, it changes on down payment, your credit score. Those are the things that could change it. So it is a huge. It could when you start getting that lower credit, it could be like you said, hundreds of dollars a month that you didn't have to pay.
Yeah, because like right now I've got a client, they're buying a $400,000 house. They're putting 10% down and we're doing an FHA loan for other reasons, credit score and some other factors that we'll kind of get in. But because they're putting 10% down, mortgage insurance is slightly cheaper, so 0.5, not 0.55, and it's $150 for a $366,000 loan.
Now you switch that to conventional, that 150 is probably going to be 300.
Right. But why are we not going something? Derek, why aren't you going conventional? Well, because they had a bankruptcy a few years ago.
Yeah.
And seasoning requirements for FHA are less than the seasoning requirements for conventional. When I say seasoning requirements, that just simply means the time you need to wait from a specific event.
Yeah. So seasoning, so like on on bankruptcy, it's not when you enter bankruptcy, it's when it's
dismissed or discharged.
Yep, discharge the word. Yeah, dismissed or discharged. That date, when that happens, then it's depending on the type. There's certain I know 2 years. Usually that's like the first threshold. 2 years. I know you can do some in 12 months depending on the circumstances.
Right.
But usually it's a 2-year wait to go FHA.
So what we have to look for, if you have this in your past, short sale, bankruptcy, and this Bankruptcies, we're talking about chapter 7, 11, 12, 13, or multiple bankruptcies, a foreclosure or a deed in lieu or pre-foreclosure charge off of a home. You're looking at several different like line items that you have to look at for the seasoning requirement. So conventional, like I'll just use an example to compare. Um, let's go like what is it more common? Chapter 7 bankruptcy.
Yeah, I think so.
For conventional, it's a 4 year from discharge or dismissal date, or 2 years if documented extenuating circumstances and with reestablished credit. So if you have a Chapter 7 bankruptcy, typically it's 4 years that you have to wait before you can purchase a home. Chapter 7 under FHA is 2 years with established credit. 2 years. You just cut it in half. So there might be somebody out there with phenomenal income. They've rebuilt their credit up. So they've got 700 credit score. They've got money in the bank and they want to buy a house. Are we going conventional if they had a Chapter 7 bankruptcy 2 years ago? Not if we don't have extenuating circumstances. So you're going FHA, and that buyer is a strong buyer.
And the extenuating circumstances, like, hey, you shouldn't pay your bills. Hey, you lost your job. That those usually don't count. Now, I've seen the only time I've seen it get approved is somebody had cancer and they couldn't work.
Right.
And they went to Chapter 7 bankruptcy. And then it's been 2 years and they were able to go to conventional. That was the only, because they paid everything on time, then cancer hit, and then stuff started switching over, and then they went back to work.
Yeah, we had one that was the death of a business partner.
Yep. So
but we had to document it like death certificates, and it was awkward. Like, well, we'll need this and this and this. Like, are you serious? I'm like, we've got to document the extenuating circumstances, and this will work.
It's got to be in the file.
Correct. We got to prove it. So just those seasoning requirements, a little bit more lenient on FHA again. So I would say, like, which one's more lenient? FHA.
FHA is. And that's what it is, purposely designed that way, to be more lenient, to help more people do the American dream and buy a home. It is not a forever one. Is you're in there for a little while and then you're going to either refinance it and get into conventional, maybe even get a better rate, get that mortgage insurance off. All of those things really help people. What most people just don't think is that it's just for people that have bad credit and bad all the
well, and here's like one of the myths that I hear too, like, oh, well, you need a bigger down payment for conventional. Technically, if you're a first-time home buyer, you can put as little as 3% down. That's less than FHA's minimum 3.5%.
Exactly. And then what's a first-time home buyer?
If you have not owned a home in the last 3 years
and occupied it, you're a first-time home buyer. So if you have a rental property, I've had somebody there. We have a rental property. They have a property that was a primary somewhere up north, and they've been in Florida since I think 21, renting. They are technically a first-time home buyer because they have not occupied the house up north at all. Somebody's been renting it.
What if somebody built an investment property in another state?
You're not a first-time home buyer. You're a first-time home buyer if you haven't lived. It's occupied. That's the key. Owned and occupied in the last 3 years. Because I've got people where they've co-signed for parents and trying to do a first-time home, like they try to do hometown heroes. You got to be a first-time home buyer. They were a nurse, and they're on a mortgage with their parent, but they never lived there, so they're considered a first-time home buyer still.
Yeah. So I mean, I've done, especially like Home Ready, Home Possible. So within Fannie Mae and Freddie Mac, they've got special programs for first-time home buyers. Where it's usually based on income limits. So you've got to look up the area median income limit. And if you're underneath certain thresholds, you can qualify for this program, and interest rates are significantly cheaper.
I had a client recently. So she's a first-time home buyer. She's got a lot of money saved in like a retirement account that she can withdraw from. She's only withdrawing a very small portion. So then we needed her to withdraw more to be able to count it as income. So she was going to do that, but she's like, "Oh, I'll just do 10,000 a month," because like she could do 10,000 and that was fine. But I was like, "No, don't do that." And she's like, "Why?" I'm like, "We only need like 6. If we keep you at the 6, you actually are going to qualify for a better rate because you're going to be in the home. I think it was Home Ready that she qualified for, but because off of her income, now her income is lower. But if she took that 10, she would not qualify. She would have to pay a higher rate. So sometimes it's just like knowing exactly what money to put in there to get it to work
Right.
is huge.
Well, and that's one. There's another time where I had a buyer. They had gotten pre-approved elsewhere, but their agent was just like, just get a second opinion from Derek Brown, and it worked out great because she qualified for Home Possible
Yeah.
based on their income, and they were buying a condo, and based on their credit, the condo, everything. Like my interest rate was so significantly less than the other lender, and the other lender tried to say like, oh well, he like they've got some special program that isn't available to other lenders. And I'm like, well, it's a Fannie Mae program. You can do it. You just don't know what you're like. You don't know to look for it.
Yeah. They don't know
That's
what they're
all.
doing. That's
Right.
that's that's what I said. Like it doesn't matter if somebody's going FHA or conventional. It's all on the loan officer in that company. Can they
Right.
actually close it and do it and know everything with it?
Yeah. So you don't need perfect credit for either
No,
one of these programs.
don't need
But
perfect
I
credit.
will say, the higher your credit score, the more opportunities and more loans become available.
Exactly. You most definitely, and it's what every 20% or every 20 points is kind of like special. And everybody can go look this up. It is loan level pricing adjustments. Is that the
Yeah.
word I'm looking
Loan
for?
level
You
pricing
can go
adjustment,
Google this.
LLPA.
It'll tell you on I think it's Fannie that rate comes up first when you Google it, and it's the second page on the PDF when you look at it. It'll tell you how much what your credit score is, what bracket, and your down payment, what the overlays that'll be added onto the current rates with it.
Right.
So it's almost I think it's like somebody that has like a 600 and something with the magic number is always once you hit 40% down, your loan level pricing is the same as somebody that has 800 putting 40% down.
Right.
So it's public knowledge out there. I always tell people go look at it. This is exactly what will tell you the difference of rates between your just down payment and your credit score on Fannie loans, which are conventional.
Yeah. Now, if we're going higher in DTI, there's a really good chance you're going to be looking at FHA
Yeah.
because they're more lenient. And I mean, when we're looking at income and like, well, what if we, a little bit more down, or what if our rate was a little bit lower? Sometimes it's not enough to move the needle the way we need it to.
Mhm.
So higher DTI, you can get away with FHA. They're a little bit more lenient than conventional. Um, so it just gives you more breathing room. And then when it comes to mortgage insurance, you kind of have to compare the two.
Yeah.
I mean, I go back and forth between conventional and FHA and look at the total picture. And there's times where FHA has had cheaper mortgage insurance, and there's times where conventional had cheaper mortgage insurance.
Mm-hmm.
So it's just a matter of figuring out what works best for the client.
I will say there people get worried about FHA appraisals versus conventional appraisal. It's easy to change a conventional appraisal to an FHA appraisal. That's usually
Because
very
the
simple.
appraiser has to be
Certified, which
certified with
we
FHA.
have certified ones that usually that when they
Usually they're both.
they're both. They can do both. Most of them can do VA, FHA, and conventional, so they can do it. It is the thing that you see on FHA. What comes up is that might be need repairs that need to happen. And usually where I'm at in South Florida is, hey, there's a roof tile that's cracked,
Right.
which is somebody goes up there with, I'm gonna say caulking because I don't know exactly what they, but
Glue.
they glue it, they just caulk it between it, push it back together, take a picture of it, and send it to the appraiser and say it's fixed. That's it.
Yeah.
You
I
know, it
mean, it
happens
could
all the
come
time.
out that there's peeling paint.
Yep.
That's an issue. Water damage is an issue. But honestly, like a lot of it, it may not get flagged on a conventional appraisal, but it's something that should be addressed,
Yeah.
in my opinion. Like if I'm buying a house, I don't want with peeling paint. Just saying. So yeah, there's differences in the appraisals. And if an appraisal is done for an FHA loan on a house, it sits like it
It's a
attaches to
lot.
that property for
Yep.
6 months.
So
So
if buyer A went to go buy a house, FHA, got an appraisal done, and it said it was worth 300, they decided to not buy it for whatever reason. Buyer B comes 3 months later, it's worth 300. That FHA appraisal is still going to be on there.
right,
Unless the only way to get it off is you can prove that there was a dramatic shift in the market, which yes, that happened in 21, 22. There was dramatic shifts for those 3 months. Normally, can't prove that.
right. So, but I mean, if you have a conventional buyer put in an offer, appraisal's done, comes in at 300, and then they decide to cancel, and then you get another conventional buyer, a whole new appraisal needs to be done, and the value can come in different.
Yep, exactly. Yeah, on FHA they'll just transfer it over.
Yeah. Right. What else you got? Anything else you want to bring up regarding conventional FHA? I feel like we just covered a whole bunch of shit.
That was a lot.
Yeah.
I just think people just
Which one's better, Stephen?
depends on the buyer.
Depends on the buyer.
Always depends
It's
on the
such a
buyer.
political answer.
It depends on the buyer and it depends on their long-term goals and situation. I've had it where FHA makes sense. I've had it where it was. I'll tell you one. I had one that it was her ex-husband six or so, it was like 6.5 years ago that they were putting 30% down that we had to go FHA because her ex-husband got what happened, but a bankruptcy or something happened that we needed a 7-year waiting period. And she couldn't get a hold of him for him to write a letter to say, hey, it's going to be, she wasn't involved. Like we just needed something to say that. But she's like, I haven't talked to this guy in like 5 years. Like, why would I, try to get anything? And I was like, well, you can still buy this house. It's going to go FHA. You're going to have this mortgage insurance. And then I think it was a year and a half later, rates started dropping. So then we refinanced her out of it. But it was like, it kind of threw a curveball for everybody when this came up. It's like, oh, I was like, can you get this letter? She's like, I'm going to try.
Yeah.
So it just depends on the situation. And like I've always
Well,
said, it depends on the loan officer. That's everything comes down to the loan officer. Can they actually close it? Do they know what they're doing? Because me telling you you're conventional and not actually doing a pre-approval very well and going through everything and be like, oh yeah, you're conventional, go ahead because your DTI says 35, and then finding out
I
you can't
have
actually close it.
I have clients right now that are pre-approved for a very healthy number. Um, like 900,000. And about 15 years ago, they did an FHA loan with down payment assistance on their first house. And they paid down their mortgage, ended up selling that house, paid back the assistance, bought their next house with a decent down payment, like I think like 10% down. Then lived there for a few years, sold that house. They had done a couple of little renovations, made it real nice, sold it, net even more. And then bought another house. And they just did this slow, move up, every couple of years. And now they're looking at like a 900 something thousand-dollar purchase price, putting about 450 down.
The FHA was a horrible loan for them.
Yeah, so bad. Why did they do FHA
And it's
15
just
years ago?
that sometimes it's just the first stepping stone. Just
Yeah.
get it in there.
And if they had
That's
listened
it.
to somebody who's like, oh, FHA isn't good, like, I mean, they wouldn't be where they are today. Now, granted, their income is increased and stuff like that, but the amount of equity that they have in this current home as a result of when they bought 15 years ago, that's what compounded over time.
Yep.
And yes, their income did go up, but not as much as the appreciation in the equity.
No, exactly.
So
I think
I
you
don't
just
know.
like we just have to when we have that buy, we just run both options and look at it. And I always like to compare it. Like here's conventional, here's FHA. If they qualify for both, I want you to see it. I want you to
Right.
see both of them. In certain house, it might come down to a certain house. Hey, I want this house. Well, that's gonna have to go to conventional. Or hey, it can go FHA. Like then you decide between the two.
Yep.
Especially if you're using down payment assistance. Using down payment assistance, the rate could dramatically change between FHA and conventional.
Big time.
So
So if
people are like, oh,
you're
just
if
I'll
you're
do
looking to
FHA.
buy a house right now and you want to try to determine which loan option is better for you, FHA, conventional, and you want a side-by-side comparison, reach out to us. We'd love to help you.
Yep.
And that's it.
It's that
This
simple.
has been another episode of the Brutally Honest Loan Officers